This is the story of one person, and it begins at 2 in the morning on a Tuesday, when this person couldn't sleep, so opened the banking app. The balance appeared, $214. Not $214 left after deducting all expenses, but the entire savings, worth only a mid-range pair of sneakers. Nothing dramatic happened that night. There was only this person sitting in the dark, looking at the number, and wondering if they had to live like this forever. 8 years later, this person has $200,000 in the account. Not from winning the lottery, not from an inheritance, not from a reckless investment in something that suddenly spiked. Just 8 years of doing very boring things, but consistently, without giving up halfway. If you look at your account right now and see it's not much different from $214, then this is the story for you. At age 32, the night of looking straight at the truth. 6 months before that night, this person had once opened a spreadsheet file to calculate expenses, then closed it right away because they couldn't bear what it showed. But tonight, at 2 in the morning, this person opened it again. Annual salary was $68,400. It sounded fine, until broken down into each item. Rent per month was $1,550. Car payment was $387. Insurance was $210. Minimum student loan payment was $280. Food was $340. And there were $94 for monthly subscriptions, including one this person didn't even remember signing up for. Adding it all up, the amount left for free spending was $1,079. That still sounded fine. But when opening the credit card statement, the actual amount spent on everything else was $1,340. That meant every month, this person was spending $261 more than they had. And this had been happening steadily for 2 years. Nothing dramatic happened after seeing that number. This person just sat still in the dark for a while. But something had changed, however small, like finally admitting a problem they had avoided for a long time. That night, this person understood 2 things. First, the 20s, the period financial books often mention, the kind of just invest early and get rich era, had passed, unrecoverable. Second, that didn't mean it was too late. At age 32, if $600 were invested each month into a fund with an average annual return of 9%, then by age 62, there would be about $1.1 million. This wasn't a miracle, just a simple calculation. But to have $600 each month, one had to start from a much smaller number, the first $1,000, set aside separately, untouched. This was harder than imagined, because at age 32, an unexpected incident, a car repair, a hospital visit, or an urgent flight home, could take that money away at any time. But this person still began. Sold an old jacket, got $85. Canceled 3 unused subscriptions, saving $94 each month. Cooked at home for 6 straight weeks, saving an additional $180. Took on extra weekend shifts, earning an additional $320. And didn't tell anyone, because it felt a little embarrassing to have to do that. One morning, checking the account, the balance appeared. $1,043. No one knew about this. There was nothing to show off. But this was the first time this person felt something certain. They could change the direction of everything. Age 33. The car creaking in the middle of winter. After getting the first $1,000, this person began setting up automatic monthly transfers. $400 into a Roth IRA retirement account. $200 into a high-yield savings account. The money was deducted right on the 2nd of every month, before there was a chance to think up a reason to keep it for spending on something else. Life on the remaining amount was fairly tight, but still manageable. Then one Wednesday morning in mid-February, when the temperature dropped below 0, the car started making a strange noise, a low, drawn-out groan, coming from somewhere underneath. This person pulled into a gas station, called a mechanic, and got the answer they had already vaguely guessed. The repair cost was $2,300. 3 years earlier, this number would have been a major shock. It might have meant swiping a credit card, promising to pay it off in a few months, then letting that debt sit there for the whole year, quietly weighing on the mind whenever it came up. But this time was different. The savings account already had enough money. This person transferred the funds, paid for the car repair right away. No need to borrow. No interest incurred. No need to push back any other plan. Sitting in the car while waiting for the repair to finish, this person didn't feel any particular joy. The feeling at that moment was calmer than that, as if a problem that once could have ruined an entire month was now just a small incident, handled and done with. 4 months after that, this person set aside money to replace exactly the amount taken out for the car repair, without missing a single transfer. The emergency fund returned to what it had been. No one knew this had ever happened. Age 34. A small decision at the home goods store. That year, the stock market dropped 18% within 4 months. Watching the invested money decrease day by day was not a pleasant feeling. This person checked the investment account constantly for the first 2 weeks, then forced themselves to stop doing that. Money still went in steadily every month as before, even while stock prices were low, even though deep down there wasn't complete certainty that this was the right decision. No investment was withdrawn. By the end of the year, the account value returned to exactly its original level, as if that decline had never happened. But the real change of that year didn't lie in the stock market. It happened on a Saturday, at a home goods store, when the old coffee maker that had lasted 6 years finally broke. Standing in front of 2 choices, one machine priced at $39, one at $119. Out of old habit, this person would have picked the cheaper one right away without thinking. But this time, this person paused and calculated. The machine was used every morning, twice on weekends, about 400 times a year. Over 5 years, that was 2,000 uses. The more expensive machine had a 5-year warranty, while the cheaper one didn't. Worked out, the cost difference per use between the 2 machines was only about 4 cents. This person chose to buy the $119 machine, carried the box out to the car, and sat in the parking lot for a moment to realize something. They were no longer making decisions based only on the next 30 days. The way of thinking had shifted to thinking in terms of years. Not from forcing themselves to follow some rule, but because it had become a natural reflex without noticing when. That wasn't some grand milestone, nothing to tell anyone about. But this quiet shift in thinking, not any saving trick, was what truly made the difference later on. Age 35. The company lays people off. A close friend buys a luxury car. In March of that year, the company sent an email announcing restructuring. Right after that, the atmosphere in the company changed noticeably. Everyone became unusually quiet. Most conversations shifted to private messages instead of the group channel. Everyone understood what the word restructuring usually meant. That evening, this person went home and recalculated their financial situation. If they lost their job, the current savings were enough to cover about 3 months of expenses at the current level. A number known exactly because spending had been tracked steadily for the past 2 years. The investments could also be used if a deeper layer of protection was needed. The situation wasn't absolute safety, but it also wasn't at the level of falling into crisis after losing just 1 month's salary, like in previous years. 2 weeks later, the layoffs officially happened. 11 people at the company lost their jobs. This person wasn't among them, but 3 close colleagues were. Watching them pack up and leave the office one morning, this person felt relief at not being affected, along with guilt over that very feeling of relief. After this person decided to raise the emergency fund from 3 months of coverage to 6 months, without withdrawing any investment to do it. Also that year, a close friend named Marcus bought a brand new BMW 5 Series, financed over 72 months at an annual interest rate of 6.9%. Marcus didn't say directly that it was a financed purchase, just called it leasing the car and quickly changed the subject. But this person worked it out. With those loan terms, the total amount paid for the car would be over $77,000, while the car's actual value after a few years would drop to less than half of that. Sitting in Marcus's car, feeling the smoothness and luxury, this person had a fleeting thought too. After being disciplined with money for so long, didn't they deserve to reward themselves with something like this? But instead of arguing against that thought or blaming themselves for having it, this person simply noticed it, let it pass, and reminded themselves of one thing. Wanting something wasn't the problem. The question was whether one was willing to trade away time and future choices to have it right now. In the end, this person stepped out of the BMW, went back to their own old car, and kept using it as before. Age 38. Mother's phone call. In April of that year, this person's investment account crossed the $50,000 mark for the first time. This wasn't a particularly exciting milestone, but more like a foundation now solid enough to start bearing bigger things built on top of it. A few months later, on a Sunday evening, this person's mother called. Her voice sounded somewhat hesitant, as if she had thought carefully before saying it. Her roof had been leaking for months. She had tried to endure it as long as possible, but finally had to call someone to check it. The repair cost was $6,000. She had asked around a few places, but didn't know how to manage it, and felt somewhat reluctant to ask her children for help. This person answered right away, without needing to think long. "Don't worry, Mom, I'll take care of that." The next day, the money was transferred. No need to borrow, no need to withdraw any investment, no effect on the existing financial plan at all. What stayed after that call wasn't the $6,000, but the way it was handled. 5 years earlier, a similar situation might have forced this person into debt, or left them quietly feeling guilty for not being able to help family without affecting their own finances. This time, everything happened smoothly, without any tense calculation attached. This was also when this person more clearly realized the true meaning of saving and investing over the years. It wasn't just a number in an account, but the ability to be present and help important people when they needed it, without having to trade away their own stability. Age 39. Money begins making money, and a kind of loneliness no one talks about. That year, this person's investment account grew by more than $9,000 purely from returns generated by the money already invested, not from any new money added in. In other words, the money had started working on its own, without extra effort, even on days when money wasn't thought about at all. That same year, the credit card debt had already been paid off earlier, and the student loan was finally paid in full in one transfer. But there was one thing this person came to realize, something no one usually mentions when talking about building wealth. A rather particular kind of loneliness. Most close friends, people known for over 10 years, weren't heading in this direction. Some were genuinely struggling financially. Some had high incomes, but spent every bit of it each month. Some had almost no concrete plan for retirement later on. This person had once tried bringing up saving and investing with a few friends, gently, without pushing, but no one changed their spending habits afterward. From that, this person drew one conclusion. Each person only truly changes how they see money when they face, on their own, a number they can no longer ignore. Like that night at age 32. No one can create that moment for someone else. So, this person chose to stop talking much about this with friends, stopped turning saving into a topic of discussion, and simply kept going quietly in their own way. Age 40. Looking back on the journey. On the very day of turning 40, before doing anything else, this person lay in the dark and remembered that night 8 years earlier. The kitchen table, the sound of the heater running, the number $214, and the spreadsheet file that had almost been closed again. Afterward, this person opened the banking app to check. The balance appeared. Over $200,000. Not a millionaire. Not the kind of financial freedom often seen on social media. But that number was nearly 6 times the average for a 40-year-old American, which was only about $35,000. Not from an inheritance, and not entirely from luck, though this person admitted luck played a small part too. Most of it came from having started early, keeping up the habit of saving and investing steadily even before seeing clear results, handling emergencies with savings instead of debt, and staying the course even during periods of market volatility. Looking back on those 8 years, this person realized something different from what they had once thought at the start. At first, wealth had simply been imagined as a number in an account. But in reality, it turned out to be the feeling of being able to fix the car without worry, of being able to help their mother without hesitation, of not panicking upon hearing news of company layoffs, and the feeling of waking up each morning knowing they were actively building their future, rather than letting it happen and then scrambling to cope.